Hello, everyone, and welcome to this webcast. Today, we'll be talking about all things solar tax credits. So, really talking about solar ITC, the investment tax credit. This is a broad topic, a lot of things to get into here, but my goal is to cover a lot of ground, but keep it very practical and hopefully insightful. My name is Trey Raymer. I'm the CFO of 820. I am a CPA, have over 20 years of experience, over a decade at EY, a big four public accounting firm, over a decade in senior finance and accounting leadership positions. I am a CPA, but I'm not providing CPA or legal advice on this, but I am providing information. So hopefully you find this to be helpful. So let's jump right into it. Okay, our agenda for today, we're going to go through the Inflation Reduction Act because you really can't talk about solar tax credits without talking about the IRA. Go through how does this impact commercial businesses? How does it impact tax-exempt entities? How does it impact residential homeowners? And then deal with some specific topics within this broad scope of wage and apprenticeship requirements in certain circumstances, transferability. I want to go through a very detailed example that I think will hopefully highlight and make this very clear on how these calculations work, how these incentives can benefit those parties. And then we'll go through some just frequently asked questions, things that we get asked all the time that I think will be helpful to go through together. So first of all, the Inflation Reduction Act, the IRA, that legislation passed in 2022. When it did, it provided certainty to the industry where it really hadn't been that way before. So a decade plus of tax credits and incentives around renewable energy. The price tag of the bill for the renewable energy components is $369 billion, although it's uncapped. And so recent estimates have put that number of over $1 trillion. So there's a lot of incentives there for businesses, homeowners, tax-exempt entities, and others to benefit from. All right, we'll start with commercial buyers. So for a commercial entity, that investment tax credit is going to start at 30%. But can actually go all the way up to 70% in certain circumstances with adders that I will get into. There's a little asterisk there on the 30% because it starts at 30% as long as the project is 1 megawatt or below. If the project is above 1 megawatt, then it has to meet the prevailing wage and apprenticeship standards that I'll talk about a little bit later. Otherwise, that 30% drops to 6%. So it's a big deal to make sure that those are met when you have a project over 1 megawatt. In addition, standalone storage, battery storage now qualifies for the investment tax credit as part of the Inflation Reduction Act. One thing to keep in mind with these tax credits is they're not refundable tax credits for a commercial buyer, so you have to have that tax liability to be able to benefit from it. One great incentive that was put in place for commercial buyers is that you may not have that tax liability in the current year, but you can actually go back 3 years. You can carry back 3 years or carry forward 22. So that's very helpful to many customers out there. Currently, bonus depreciation, which bonus depreciation means you're able to take a certain percentage all in that very first year, is currently in 2024 at 60%, and it's stepping down 20% each year. There's actually legislation going through Congress right now. It's passed the House, hasn't yet passed the Senate. So it's politics, you never know. But that legislation would actually bump that back up to 100% for bonus depreciation. Everything that's not captured under bonus depreciation is under a 5-year maker's schedule, though. So we'll walk through that in the illustrative example later. Another thing the Inflation Reduction Act did is it allowed that ITC to be transferable for a commercial buyer. So you may not have the tax liability, but you can actually sell that to a third party who does have it. So that's opening up a new market and new opportunities that previously were not there. So I mentioned those stackable tax adders. You'll see it on the screen here what those 3 items are. So you start with domestic content. And as the name suggests, as you have projects that are installed utilizing domestically manufactured content, that will receive an additional 10% adder. That's something that we expect to become prevalent here in a few more months. By the end of year, early next year, the Inflation Reduction Act, one of the things it spurred was the creation of a domestic manufacturing industry that previously didn't exist, um, certainly not very robustly, as a lot of the solar panels, inverters, those types of things historically have come from other countries, but that's not going to be the case too much longer. And to incentivize that, there's this additional 10% adder on top of the 30% base investment tax credit for domestic content. The next is energy community. So if you're in an energy community, you are actually able to get an additional 10%. So what's an energy community? So one would be if it's in a brownfield site. Two would be if it's in an area that had a coal plant closure. And then third would be it's an area that has a certain percentage of oil, gas, or coal employment and a certain percentage of unemployment combined with, you combine those two things together. And that is how you get to the three different ways of achieving an energy community. There's maps that are available. I'll show you one here in a minute that gives you a good illustration of throughout the country. There's a lot of areas that would meet that classification of being an energy community. That's an additional 10%. And then the third and final one is the low-income community adder. There's actually 4 different categories within that one adder, and I'll talk about those in a minute. 2 of them give you a 10% additional credit, and then 2 others give you a 20% additional credit. So you can see on this slide here how you can go from the base 30% all the way up to 70%. I haven't seen many projects that get all the way to 70, but a jump up to 40% or 50% is huge on a lot of these projects. So those are important concepts, and we'll get into them a little bit more here in a moment. So here's that map I was referring to of energy communities. So you're looking at the United States here. Everything that has a color on here is an energy community. But just by being in that address, you type the address in on this map, and if it shows up in one of these colors, then boom, you get an extra 10%. Don't have to do any more than that. Very simple for that particular adder. The next one I'll talk about is low-income communities adder. And this one I've actually done a separate 30-minute webcast on. So if you really want to dive into it, I would encourage you to look out for that one. Reach out to me. I can send it to you. But here on this webcast, just at a high level, those 4 different categories that I talked about, if you look at the first 2 on the left-hand side, those are the 10% adders. The first is they call it a low-income community. And it's effectively, you look here on this map, this is the map of low-income communities. You can see everything in green is a low-income community. That's a lot of the country. So many different areas can benefit from this. And under this category 1, low-income community, you think about that as a commercial business that happens to be in a low-income community, or an apartment complex that happens to be in a low-income community would qualify there. The second one is if it's located on Indian land. And you can see the definition, won't read it, but you can see it. Here's a takeaway of how you meet the definition of being on Indian land, but that's an additional 10%. That map I was just showing you, just to be clear, is only for category 1. There's no maps for these other 3, for category 2, 3, or 4. You get to category 3, then you see the low-income residential building project. Think LIHTC, low-income housing tax credit, apartment complexes, Section 8 housing, things of that nature. You can see the definition here. That can get you up to a 20% adder. And then the 4th is a low-income economic benefit project. Think community solar, where at least 50% of the financial benefits are provided to households with income of less than 200% of the poverty line, or 80% of area median income. So that's a flavor of that adder. And again, this map here, this shows you the category 1 low-income communities that are out there. This next map I'm showing you is a subset of this adder, which is called disadvantaged communities. And the reason I'm highlighting this is because the way this program works is half of all of the awards are going to those that meet these additional selection criteria, one of which is ownership. So if it's a nonprofit, tribally owned, there's a few others, very specific type examples of the ownership. But on geography, it's if you're in a disadvantaged community, and that's these in purple that you see on this map. They get moved to the head of the line. And the thing with a low-income community adder that's different from domestic content or energy community is that low-income community adder is limited to 1.8 gigawatts of capacity to be awarded each year. And it's broken down between those 4 categories even further. And that's why when I was mentioning this additional selection criteria, that comes into play, because of that 1.8 gigawatts, half of that gets allocated to those that meet additional selection criteria. On domestic content, so requirements here on this one. So anything that's a structure, including solar, let's say it's a solar canopy, carport, something like that. 100% of the steel or iron has to be U.S. manufactured, has to be U.S. made. And then for any manufactured products, think about a solar panel as a manufactured product. There's many pieces that go into that. There's different percentages that have to be required to be domestically manufactured to meet this definition. So in the current year, 2024, it's a 40% has to be domestic. That actually increases by 5% each year until it reaches 2027, when it's 55%, and then it stays at that level moving forward past 2027. So this one it's an interesting one. We'll see it become more and more prominent as there's more manufacturing facilities that open. It's important when you look at the definition and the calculation that you see. I've shown you at the bottom of the screen. It's a little bit technical, and some of those pieces include things like knowing the labor costs of different things that are produced. And there's a lot of conversation around the fact that manufacturers and others aren't necessarily wanting to provide that level of granularity. There's some competitive advantage that they're not going to want to necessarily communicate. But when you think about the way this percentage works, and if you think about it in a solar situation, you've got your main components, you've got your solar panels, you've got your inverter, you got your racking. And if you're able to have manufacturers certify each of those that meet the domestic content percentage requirements, then mathematically you get there. And so I'm expecting that that's kind of how that's going to play itself out over the coming months and years. We'll note here in the second bullet point that you must include a signed certification statement from an authorized person under penalty of perjury in that tax return. So it's very important that you have good confidence in whomever you are working with from a solar installer perspective, that will be able to provide you that documentation, give you that comfort to be able to sign that statement under penalty of perjury in your tax return. For tax-exempt buyers, this is a new thing within the Inflation Reduction Act, provided what's called direct pay. What that means, for a tax-exempt buyer, there's no tax liability to need to offset. So rather than going that approach, the way the legislation put together is there's actually a check that would be written and sent to a tax-exempt entity that is installing solar, as an example, on their facility. And that, the percentages are similar to what you see from a commercial entity. Starts at 30%, does include the stackable adders that I talked about earlier, includes both solar and storage. For a tax-exempt buyer, the domestic content, there become requirements that they do meet the domestic content on those projects, or else the benefits start reducing over time. Now, that's only for projects that are greater than 1 megawatt, but it becomes important over time that those tax-exempt entities, for projects less than 1 megawatt, have their materials sourced domestically. And the third one I'll get into, residential buyers. So for residential buyer, again, the 30% ITC for solar and storage. There are no adders for residential buyers. It's it's a different piece of the tax code, Section 25D for residential versus Section 48 for commercial. But again, this is not a refundable credit for residential, similar to the commercial buyers that we're talking about earlier. So you've got to have that tax liability to be able to utilize it. There is no ITC carryback on residential for residential homeowners, but it does carry forward through 2034. It's important to know that when you're able to take that credit is the year in which you've achieved substantial completion on your project. So think your installation being complete is the point in which you're able to take that ITC credit on your tax return. Wage and apprenticeship. So referenced this earlier as being a new requirement in the Inflation Reduction Act. So standards require that you've got to meet certain wage standards, prevailing wage standards by category, by employee, direct labor employee who's working on the job, and by area. So these standards, these requirements are broken down by state, by county, things you have to look at and make sure that they're being paid that prevailing wage. There's requirements that a certain percentage of apprentices be included on these projects. I'll get into some of those details here on some following slides. Now, keep in mind, these requirements don't apply in residential. This is for commercial. But it is important when they do apply that you have good documentation from your solar provider to give you the confidence when you're filing your tax returns. So, here's a little bit more detail around that. So, prevailing wage and apprenticeship requirements established with the Inflation Reduction Act. Again, if you don't meet them and you're over a 1 megawatt project, that 30% drops down to 6%. So what does that mean? Well, these prevailing wages must be paid to laborers employed by the taxpayer or any contractor or subcontractor during construction to get that 30%. Also has to be paid for any alteration or repair during the 5 years after a project is placed in service. And the taxpayers got to maintain records, pretty extensive documentation requirements in place around this. From the apprenticeship side, participants have got to utilize federally registered apprenticeship programs. And, on the apprenticeship side, there's no requirement that those requirements be in place after the project's placed in service. As far as the percentage is concerned, it's 15%. So 15% of all laborers need to be apprentices every day on the job. So those documentation requirements are very important. And if there's any subcontractor who employs 4 or more individuals, at least one of those has to be a qualified apprentice. So you want to make sure, as you can see on this slide here, in the bottom left corner, so us as a company, what kind of commitments do we make to our customers in this situation? You can see it here, that we'll provide this documentation to support the things that give our customers the confidence they need to be able to take this in these certain type of projects. You can see both from a prevailing wage and from an apprenticeship perspective. And this is something that customers should expect from their solar provider. Next is transferability, a new thing in the Inflation Reduction Act. Allows you to sell your credits if you're a commercial entity. Now, in this setting, you're not going to be selling them for $1, $1 for $1. It's going to be some percentage of the credits that you'll receive, and the markets will dictate kind of how high or low that percentage will end up being. What I wanted to put on here is just sort of some FAQ type items on this that may be of interest to you. So in a situation where you want to sell a tax credit, how do you go about doing that? So you first have to arrange with a third party to exchange that tax credit for cash. And there's markets and brokers that are forming. This is a new type of activity, if you will. And so there's things popping up all the time to help facilitate these transactions. As the one selling the tax credit, you actually have to go out and register that with the government. It's a similar registration process that you have to go through when you're getting direct pay as what you do with transferability, but you have to go out and get it registered. There's a transfer election statement that has to be put together with the transferor. Both have to be attached to tax returns. So what is this transfer election statement? It just sort of goes through and spells out what the transaction is, why it qualifies, and to ensure that it's attached to the proper tax returns. Who's responsible for recapture. So if there's a recapture event, it's the person buying the credit that's actually responsible for that. And so as I've seen these markets developed and been in the marketplace, we can tell is, buyers are not going to want to take on that risk. And so typically there's an insurance component to these transactions, some type of indemnity or personal guarantee around them, because someone looking to buy a tax credit is looking to minimize their risk. What we've seen in the market is typically there are larger deals that generate larger tax credits that are of interest to the market because of things like having to buy insurance and the due diligence. That's just a cost of that has to get worked through. Now, over time, there'll become more and more markets, and smaller credits will be able to be transferred as those markets get more mature and develop. Those are just some of the things that we're seeing so far. And then last, can the transferee take depreciation? No, they cannot. So they're really just getting the benefit of the ITC and not the benefit of depreciation, of the accelerated depreciation. This slide here, I know there's a lot on it, but I think it's really helpful to kind of walk through an example commercial solar situation with an ITC and the depreciation and how this can impact the economics of a project. So in this example, it's a commercial deal, and it's done with, it's not a C corp, but it's an entity. Let's say it's an LLC with a pass through, so pass through rate to the individual tax owner. And so here in this example, it's a $2.7 million deal where there's the ITC is 40%. So it's the 30% plus one of the adders on that. So if you can see here in the top left, that ITC calculation, 40% of that 2.7 million. So there's $1 million right there for your ITC benefit in year one. From a federal depreciation perspective, how does that basis work? Well, the way that calculation works is that you get half, you remove half of the ITC. So you can see this, it's 100% less 40% divided by 2, that's 80%. So you take 80% of that basis, that's the $2.2 million number here, and that's your basis for depreciation, both for federal and state. For a project placed in service in 2024, it's 60% bonus depreciation. So as you look at each of the years on here, for this individual, it's a 35% federal tax rate times that basis. And you see it's 68% here. And the reason it's 68 is you get your 60% bonus depreciation. That remaining 40% is depreciated using 5-year makers. So year one under 5-year makers plus the 60%, that gets you to the 68% here. And so on and so forth for the rest of those years. You can see how that benefit gets spread out on a state basis. This example state has 4.75% tax rate multiplied by the basis, and this is just using the 5-year maker's schedule. So when you look at the impact on your tax liability in year one on this project, you're taking your ITC plus your federal depreciation plus your state depreciation. That's over $1.6 million of benefits there, and that's about 60% of the project you're getting back in benefits in year one. Over the total life of the project, it's about 72%, a little under $2 million of benefit there. So you can see how powerful these incentives are for these projects. So with that, I'm going to kind of turn over to just a few frequently asked questions that we get in these situations. Some of these I've already covered in the presentation, but a few are unique. So as I go through that, first one, the solar, does that qualify for bonus depreciation? Yes, it does. 2024, it's the 60% bonus depreciation. We'll drop 20% each year until that goes to zero. The rest is 5-year makers, unless Congress passes legislation that boosts it back to 100% bonus depreciation. Does the ITC impact depreciation? Yes, it does. You back out half of that ITC, like I was showing you on the previous calculation, on the previous slides. What are the carry back and carry forward rules for solar, for commercial? So it's carrying it back 3 years, carrying it forward 22 years. Next, does the structure holding a solar PV system qualify for the ITC? Get that question a lot. And the answer is that typically yes. So structures holding a solar PV system, so a carport over a parking lot or a solar pergola, those are normally considered part of the solar system on which the tax credit can be claimed if the solar PV system is designed with the primary goal of electricity generation and the other uses of the structure are merely incidental. Next, what are the recapture rules? So for this situation, you actually vest 20% per year in your ITC. And so if you sell your facility, let's say before a 5-year period of time, there will be a recapture event that occurs for the pieces that have not vested. So after year one, you're vested 20%. After year two, 40%, so on and so forth, until after the 5-year period, you're fully vested. For tax-exempt buyers, so question, how does a tax-exempt buyer receive a direct payment? The way that works, for the filings and how you get that cash. So it's basically as if the tax-exempt entity will file an informational tax return, and it will be treated by the government as if it's an overpayment of tax, in which case they then will send the refund back to them. So as a tax-exempt entity, they don't owe any tax. So it'll be treated as an overpayment of tax that they get back sent to them. That's just the mechanics, the way that works. Next question, does the ITC for direct pay 30% for tax-exempt buyers? And the answer is a little bit nuanced here, and it's actually that it gets grossed up in the Inflation Reduction Act by this 1.06445 amount, so that the ITC is actually a little bit closer to 32%. It's kind of a technicality, but it's a question that comes up. The next, does the direct pay also pertain to the ITC adder. So they get credit for those adders in addition to 30%. Yes, they do. So tax-exempt entity can go all the way up to 70% with those adders. For residential buyers, question here, if the tax credit exceeds my tax liability, will I get a refund? Well, as I talked about earlier, it's not a refundable tax credit, but if you have tax liability, it will be used against that. So many people in their jobs will have tax taken out throughout the year. So at the end of the year, they may not owe additional tax, but they've had tax liability throughout the year that they've been paying on. And you can absolutely use this towards that tax liability. And at that point, get a refund because of tax that you've overpaid at that point because of this credit that gets applied. Next question, what expenses are included? So it's going to be your equipment, your solar equipment, the panels, all the related equipment. It's going to be the labor costs, energy storage device. It's included in this, batteries, things of that nature. Question, is there a maximum amount that can be claimed? No, there is no maximum amount that can be claimed with tax credits. Next question, am I able to claim the credit if I'm leasing the system? The answer is no. The credits go to the owner of the owner of the solar equipment. So next, am I eligible to claim the federal solar tax credit if the PV system is not new or not being used for the first time? That answer is no. It can only be claimed one time up front. And then last here, just questions generally come out. Can I claim the credit assuming I meet all the requirements if, first one here, if the solar PV panels are on my property but not on my roof? Answer is yes. We do ground mounts, pergolas, canopies, things of that nature all the time. Yes, those do qualify for the tax credit. Next, I bought the solar panels, but I haven't installed them yet. Answer is no. Tax credit can only be taken in the year in which the installation and the solar is placed in service. So that's going to be after they're installed. Next, I'm a renter and my landlord installs a solar system. Can I claim the credit? No. Again, you've got to be the owner of the system to claim that credit. Next question, I installed solar on my vacation home in the US. Can I claim it? Answer is yes. Those solar PV systems don't necessarily have to be on your primary residence to get the tax credit. But to this next question, okay, if I installed solar PV on a rental unit I own in the US, the answer is it depends. So the residential, you wouldn't be able to claim it under the residential tax credit under the Section 25D. You potentially could do it under the commercial tax credit under Section 48, but it's very nuanced and fact specific to get there. And then the last one is I have a home office or my residence is also used for a commercial purpose. Can I use the tax credit? The answer is yes, but it's more complex. It gets more complicated. And if you're predominantly using your home for residential purposes, then you can qualify under the residential tax credit. If not, then you have to be looking at percentages and potentially the other piece could get filed under the commercial credit. So those are just a few FAQs I wanted to go through for your benefit. This next slide here, talking about us as a company at 820. We are a best-in-class solar expert. We focus on our mission every day we wake up doing is figuring out how to create more raving fans. I love being able to wake up, be able to talk to customers, educate them on these different incentives that are out there, help them see how they can benefit from them, put projects in place, and then celebrate with them when we finish those projects. But these things, they require more than just solar experience. We've got a great solar design, solar installation team, but we've got a lot of additional in-house professional services expertise that we bring to these jobs. So we've got NABCEP certified solar designers. We've got an architect on staff. We have a solar structural engineer on staff. We have electrical designers, master electricians on staff. We have folks that are experts at energy modeling, experts on financial modeling and analysis. We've got CPAs. We have a tremendous grant writer on staff who can help our customers receive all of the benefits that are out there. So with that, I will end this webcast, but I really appreciate if you have any questions. I've got my contact information right here. Please feel free to reach out to me. We love having these conversations with customers. And I hope you have a great day. Bye for now.